Hello, all of you. I hope you are doing good. Today we have to do the revision of accounting standard 16, that is borrowing cost. Very simple accounting standard. Okay, just you have to listen to me carefully, and I will tell you certain steps. If you follow those steps in examination, you have to score full mark in this accounting standard 16. As you can see that here on screen in chapter roadmap, what we are going to cover. First, we will discuss about introduction, then borrowing cost, qualifying asset, borrowing cost eligible for capitalization, recognition criteria, types of borrowing, specific borrowing, general borrowing, commencement of capitalization, cessation of capitalization, suspension of capitalization, then exchange difference on foreign currency borrowing. Now understand this one. What it says that here, first of all, what is the concept of this borrowing cost? So what should be the interest of treatment of what should be the treatment of interest? Suppose you took a loan from the bank for the construction of building. So, and if the loan is for the 10 years, but you have completed the construction in suppose 3 years only. So should we charge the interest to P&L account that, or should we add to the cost of the building? So we say, no, sir, what you're saying, it is interest is an expense, it should be take to P&L account only. No, not always that here. There are certain conditions, if we fulfill those conditions that here now, that interest can be added to the cost of that particular asset. This is what accounting standard 16. So 16 basically telling us the concept of the borrowing cost. The whole discussion is about should we charge that borrowing cost to profit and loss account, or should we add to the cost of that particular asset. Okay, this is what all accounting standard 16 talks about. Obviously, there are so many things, the methods of it, there are different types of borrowing, when should we start capitalization, all that. I will discuss with you each and every point in detail. Okay, now come to hear that introduction that here. Okay, so there are certain steps. I will tell you that if you follow those steps, easily you will be able to solve all the questions that here. Okay, now let's start it. They say that here now, enterprise borrow. Okay, enterprise that here now borrow for asset including what? Incurring what? Interest. Obviously, when they borrow the fund that here, they are going to incur what? Interest that here. Then they say accounting standard guide treatment of the borrowing cost. What should be the treatment of the borrowing cost? Should we charge it to P&L account, or should we add to the cost of asset? Prescribe the treatment of borrowing cost in asset cost. Applies to borrowing cost for acquisition, construction, or what? The production we are doing. But it says it does not deal with actual or imputed cost of owner's equity, including preference shares capital not classified as liability. Basically, they are telling us that now, if dividend is not a borrowing cost, first of all, okay, dividend is not a borrowing cost. So they say equity share capital that here is the remark, because we have raised the fund through the issue of the shares. So is the fund covered by the accounting standard 16? The answer is no. Okay, any of dividend when no, it is not a borrowing cost. Then retained earning, no, not a borrowing cost. They say preferential classified as equity, means preferential is coming under the share capital. Then that is not a borrowing cost dividend. But they say preferential capital classified as liability when dividend is fixed that year. Okay, if dividend is fixed that year, then they say that year that is a basically you raised the fund and you're paying a fixed amount of dividend to them. Then they say that it is going to be covered by accounting standard 16 that year. Okay, in general, that equity and all that, they are not a part of what these accounting standard 16. Only when the preference share classified as liability, if it is fixed dividend that we borrow the fund, we are paying them the dividend that is fixed, we have to pay them the dividend, then only it is going to cover by AS16, otherwise no. Now I'm coming to the main point now here. What it says that here, first of all, what is the name of accounting standard? Borrowing cost. So what do you mean by borrowing cost? Generally, we presume that borrowing cost means only interest. No, borrowing cost does not mean only interest. There are some other things also that is also covered under the borrowing cost. So what it says that term, borrowing costs are interest and other costs. So what do you mean by other costs? We'll discuss. Incurred by an enterprise in connection with the borrowing or fund that is. So what it includes one by one. It includes interest. Yes, that is very common. Interest is borrowing cost. But they say commitment charges. What do you mean by commitment charges? Because commitment charges means basically, suppose you go to bank and you give all the documents to the bank manager, you want to take a loan of 1 crore rupees. They say, okay, they saw your balance sheet, P&L account, all previous year records and all that, and they approve you 1 crore rupees. Okay. But you say, no, loan approved. Yes, they say, yes, loan approved. But they say, no, you don't want it right now. You want it later on when, maybe after 2 months, 3 months, whatever. So the bank is committed to you. Whenever you will tell, they will immediately disburse the amount to you. That for that, because they are ready to pay you today. But you are saying, no, paid after a few months when you will require that here. Okay, so it is approved but not dispersed that. So they charge a certain amount for that. They call it commitment charges. That commitment charges is also a borrowing cost. Then they say amortization of discount or premium on borrowing that here. For example, we issue a debenture on discount, or we do the redemption of on premium that year. So that amortization cost is also borrowing cost that year. Okay. Then they say amortization of ancillary costs related to borrowing. For example, you paying certain commission to take a loan. Okay. Those are also borrowing costs. Finance charges for asset acquired under finance rate, it is going to cover by accounting standard 19 lease that year. Then they say that exchange differences to the extent that they're regarded as an adjustment to the interest cost. So don't worry for that here. I will discuss with you these points in detail at the end. I'm going to say at the end, we are going to discuss in detail that here. Okay, what is this foreign exchange point? Okay, so now understand this point. What is going to happen when I say that here now? If I take a loan that year, okay, if I take a loan that year, we are going to incur the interest on that here now. So whether on every loan interest, when I say is can I capitalize, the whole discussion is on the capitalization or should we charge to P&L account. So when we take a loan that year, the amount of interest that we are paying, should we charge it to the, can we capitalize it? Always no. Understand the point here. What is the condition that here they say is that, understand this point. Suppose, for example, they say that, now suppose you took a loan from SBI Bank, State Bank of India. Okay. Now you took a loan from SBI Bank for the purpose of what asset? To do the construction of asset or to purchase the asset. Okay. But what is the condition that here? That asset should be a qualifying asset. That asset should be a qualifying asset. Now understand this point. So what they are telling us that now, that not, first of all, you have to understand the meaning. Then I will tell you treatment. Treatment we'll discuss later on. First, you have to understand the meaning that here. You can capitalize the amount of interest only if you took a loan for the purpose of asset, and that asset should be a qualifying asset. So you will tell me, sir, what do you mean by qualifying asset? Because we can capitalize the amount of interest. What does it mean capitalize? We can add to the cost of the PP only when that asset is, and only when that asset is a qualifying asset. So it means, what is the first condition? We took a loan. Okay, we took a loan. We are incurring the interest. Why we took a loan? For the purpose of asset. That if that asset is a qualifying asset, then only I can add the amount of interest to the cost of the asset. So now the question arises, what do you mean by qualifying asset? So they tell us that here now, the qualifying asset basically means, they say, meaning a qualifying asset is an asset, intangible or intangible, any asset that necessarily takes a substantial period of time to get ready for intended use or sale. Listen very carefully. They say here the qualifying asset means that it's taking substantial period of time to get ready for its intended use. Now, substantial period of time means generally it is say 1 year, generally, not fixed. Not fixed. Generally, any asset which is taking to get ready for its use, taking how many? 1 year. So on an average 1 year. For its use or might be for sale. It means that here now, okay, so qualifying asset means, what do you mean by sale that here? But when I say qualifying asset, I'm doing the construction of the building that here. When I say, let's decide whether it's a qualifying asset or not, one by one. So we are doing the construction of building that here. Okay. So it is going to take me suppose 4 years. So it is more than 1 year. So it's a qualifying asset. Okay. Now for use, then I will use that building. Okay. Now let's take machinery. So we took a loan for the purchase of, we want to purchase the machinery. So we took a loan that here now to purchase the machinery. Whether the machinery is a qualifying asset? No, because when you purchase the machinery, it is already ready to use, or it will not take 1 year to get ready to use that here. Okay. Machinery is not a qualifying asset. You take a loan that in India, it is common, very common for us that we take a loan from the Bajaj Finance that day. You took a loan from the Bajaj Finance to purchase some furniture. So is the interest that I'm paying to Bajaj Finance, can I capitalize it? No. Why we are taking the loan? For the purpose of furniture. Whether the furniture is a qualifying asset? No. Why? Because that furniture is not taking to you the substantial period of time to get ready for its use that day. It is already ready. You can use it immediately. Okay. So that is not a qualifying asset. It means you can capitalize the borrowing cost only when you are incurring on a qualifying asset. What is qualifying asset? Qualifying asset means that is taking substantial period of time. Okay. But they say for use, but they also say for sale. But we don't basically qualifying asset like the land and building, plant and machinery, all these. I'm going to say, we'll see that here. If they take substantial period of time, then we call them qualifying asset that. But what do you mean by sale? When I say sale that here, because my intention is not to sell all these assets, even though it's a qualifying asset. My intention is not to sell them. But they are talking about the inventory here. You know that, but you say, no, sir. Inventory, yes. If your inventory, you took a loan from bank. No, understand this. Okay, you took a loan from, and this is what? This is a PP or intangible asset. Okay. So what is going to happen now here? When I talk about a sale, so you will suppose you took a loan from the bank for the purpose of manufacturing of inventory. What you say is inventory that here, it's not a, but that inventory generally not takes, generally inventory is not a qualifying asset. Because inventory generally does not take a substantial period of time. What is substantial period of time? It generally does not take a 1 year for the purpose of manufacturing. Rarely it might be happen. Let's give you an example of wine. Wine takes so much of time because they whatever the process done, they have to in the I'm to say the wooden barrel, they keep the wine to keep it until they make it the final product that year. So if that asset is taking a substantial period of time to get ready for its sale, then it's a qualifying asset that year. So interest in general, in case of inventory, you know, in AS2 we have already covered interest. We don't add to the cost of the inventory. Interest we don't add to the cost of the inventory in general. But if that interest is a qualifying, if that inventory is a qualifying asset, then we can add to the cost of the inventory. In general, we don't do that here. So if I don't know whether you remember it or not that here now. If I go to accounting standard 2 that here, okay, if you go to accounting standard 2 that here, so in general, we don't do that. Only we can add the amount of interest to the inventory if that inventory is a qualifying asset, otherwise no. Interest, in both the case, interest, whether we are for the PP or for the inventory, in both the cases, generally we take it to the P&L account only interest. But if that interest we are incurring for the purpose of qualifying asset, what is qualifying asset, beta? That taking substantial period of time, or that is what, by either, whether it is a PP or inventory, if they are taking substantial period of time, then we can add to the cost of inventory or PP. Okay. Now, example, they say that here now, manufacturing plant, power generation facility and inventories that require a substantial period of time to bring them to a saleable condition that, okay, for example, power generation plant. So that is going to take it time. Okay. Now that is going to take substantial period of time, but they say this 1 year basically, when you talk about a substantial period of time that here now, the substantial period of time to get ready for its intended use that here. Okay. Now they say exclusion. Inventories that are routinely manufactured, otherwise produced in a large quantity on a repetitive basis or over a short period. Even say routine regularly manufactured, it means that inventory is not taking a substantial period of time. That is not a qualifying asset. Okay. Then assets that are ready for their intended use or sale when acquired. You purchase a furniture, it is already ready. You purchase a machinery, which is already ready. That is not a qualifying asset. Now the question arises that, what do you mean by substantial period of time? So this is substantial period of time. Normally 12 months is a substantial period of time unless justified differently. So depend on the fact and circumstances. It might be happen. Suppose generally during the construction of the building, it is taking 12 months. But I am using the advanced technology. So my construction has been completed in 8 months. So it is not my fault that I have used the advanced technology and have done the construction within what? 8 months that is. Still, we are to call it qualifying asset. It is taking substantial period of time, even though it has not touched the 1 year that year. Okay. So they say depends on the fact and circumstances. So what it says that depends on fact and circumstances. What it says here that consideration of technology and commercial readiness is estimating the preparation of the period. So they say, should interest be capitalized for 8-month factory construction challenging the 12-month benchmark due to technological innovation? Yes, we can add. Yes, under AS16, the 12-month guideline is flexible, not fixed. Capitalization interest for the 8-month construction aligned with the efficiency and technological advancement. That is flexible. If you use the advanced technology and instead of 12 months, you have done the construction in 8 months, no problem. Still, we are going to call it as a qualifying asset. So what we have discussed till now here, we have discussed till now that here, that loan we have taken for the purpose of asset, and that asset should be qualifying asset, then only we can capitalize it. Capitalize means add to the cost of the asset. Okay. Now understand, they say here the borrowing cost eligible for capitalization. When it is eligible, they say treatment of borrowing cost which should be directly related. What is directly related? I will explain you that here. Which is directly related for acquisition, construction, or production of qualifying asset. So in case of a qualifying interest, the borrowing cost can be capitalized. If any asset other than the borrowing, any asset other than the qualifying asset, then it is a revenue expenditure. Means it will be charged to profit and loss account. So that borrowing cost should be for the qualifying asset. If it is for the borrowing cost, is for the qualifying asset, then only we can capitalize. Otherwise, it will be charged to profit and loss account. Now they say directly attributable. What is directly attributable? They say that could have been avoided if the expenditure on the qualifying asset had not been made. So they are saying borrowing cost directly attributable means that here, if there is no qualifying asset, so no need of the loan. It means it is directly connected to that. If, let me give an example, I want to do the construction of building. If I am doing the construction, that's why I am taking a loan. If no construction, no loan. You got the point? That is directly related to this qualifying asset. If that asset is a qualifying asset, we can capitalize. Of any other than the qualifying asset, then we'll charge to the profit and loss account. Okay. Now here, I am coming to a point that here now, that is what a recognition criteria that here. What is this recognition criteria? To understand it. When should we recognize that here? Okay, they say this is a common in most of the accounting sites come. Borrowing costs are capitalized as a part of the cost of a qualifying asset when first it is probable that the future economic benefit will flow. This is very common. They're probable that future economic benefit will flow and cost can be measured reliably. Obviously, we can add that borrowing cost to the cost of the PP only when we're expecting the future benefit will happen from that asset, and you know the cost, how much is the cost. Obviously, to record it, we should know the cost. These conditions very common that, okay, these two conditions that, okay. So probable future economic benefit and cost can be measured reliably. So basically when you pay the interest, what entry do we pass? We pass interest account debit here to cash or bank account. Okay, cash or bank account. But I'm not adding to the interest P&L account. I will add to the cost of what asset. If it is what is the condition for that? If that interest is we have taken the borrowing for the purpose of asset, and if that asset is a qualifying asset, then only we can capitalize. Now, there are two types of borrowing. When you took a loan from the bank, there are two types of borrowing. First is the what types of borrowing when we talk about. First is a specific borrowing. What is this specific borrowing? To understand it, we have taken only specifically for that particular asset. For example, you took a loan from this is SBI. You took a loan from the SBI for the construction of this particular building that year. There is specific borrowing, specific for that particular asset. Took a loan from the SBI for that particular construction that year. So they say, meaning borrow the fund specifically for the purpose of obtaining a qualifying asset known as what? This specific borrowing. Then they say capitalization of what here now? The borrowing cost. They say capitalization borrowing cost on the asset by considering the actual borrowing cost incurred during the period for that period. Income on temporary investment. Let me explain this one through this table that. So what it says that here now, you borrow okay, just give me a minute now. You suppose you borrow a fund from any bank. I'm just going to example SBI that here. Okay. So you took a loan from the bank. Okay. SBI. Suppose you took a loan from the SBI. Now this loan that we have taken only for the construction of that particular building, suppose, okay. But we took a loan of, let's say, the 10 crores. So we took a loan of how much here? 10 crores that year. But we are going to pay the interest on that. Obviously, we are going to pay the interest on it. Suppose we paid the interest on this. Let's say it is coming, let's example, it is coming 2 crores, suppose. So I will say that 2 crore is the borrowing cost. So 2 crore is the borrowing cost. Okay. But it might be happen. They gave us the 10 crore rupees, but we don't need it. These 2 crore, first of all, it's the interest amount. Okay, it's a loan amount. So we don't want it 10 crore immediately, but they have given us the 10 crore. So temporarily, we invested this amount somewhere. Out of this, I invested, suppose 4 crore. I invested 4 crore and I got an interest. Let's say 0.5 hypothetically. And now this interest is an income for me. This interest is what? Income for me. So they gave me the 10 crore, but I don't want it that 10 crore immediately. So I temporarily invested somewhere and I got an interest of, let's say, 0.5 crore. So what is going to happen now? They say that here now 2 crore minus 0.5 here. So they say this any income on the temporary investment of the borrow fund should be deducted from the borrowing cost. So my borrowing cost should be how much here? 1.5, and it will be capital. It will be added to the cost of PP. So entry will be PP account will be debited 1.5 to cash or bank account 1.5. This is what we do that. So in case of a specific borrowing that here now, what we do that now, any investment if you have done out of those funds, generally people don't do that. They do for the purpose of construction, they took this loan. But if they do any investment temporarily, the income that we have received on that temporary investment, that should be reduced from the cost of the borrowing that year. Okay. Now there are two types of borrowing. Now, second type of borrowing, what is the second type of borrowing is what? A general borrowing that you know. Now, what is this general borrowing that you know? Please understand the concept and all the steps I have mentioned that here. So it will be easy for you to follow the just these steps. You will get the answer there. Okay, now understand this point that. So what it says that here now, it says suppose if I say that here now this is an here for me suppose is it visible? Yes. Now we took a loan from three banks. We took a loan from three banks that here. Okay. From one bank is charging me 12%, one is charging 11%, one is charging 13%. Okay. So we took a loan from three banks. Okay. Now I'm going to use it for the purpose of different purpose. What does it mean? I will buy it from his land and building. I will take it from furniture. I will buy it for the to pay the salary. Okay, this loan. Okay, or any other that, or let's say the factory. So it means that here we took a loan that and I'm using that particular these type of different loans for different purpose. So we call them general borrow. It is not specifically for one particular asset that here. So what we have to see that now, obviously only on the qualifying asset only we can capitalize. So if we have to see if those assets are the qualifying asset, only we can capitalize. But I'm confused here because I took a loan from a different bank, different rate of interest that here now. How to capitalize? To understand this. Okay. In case of a general borrowing, they say you generally, when funds are borrowed generally for a qualifying asset, determine eligible borrowing cost by applying the capitalization rate. Okay, we will apply the capitalization rate. We will apply that. So you will say, what is the capitalization rate? Capitalization rate is basically the weighted average rate. What is capitalization rate? That is a weighted average rate there. Okay. Now, how to calculate the weighted average? Obviously, they say here in third point that here now. Obviously, the amount that I want to capitalize should not be more than the actual borrowing cost that I have incurred. Now the question, these three steps, remember that here. So what are these three steps they're talking about now? They say here, first step is that you have to calculate the capitalization rate, and that is the weighted average rate. Now, how we calculate this weighted average rate? Now understand that. They say the step number one that now, actual interest on all general borrowing. So what we will see that one question will solve on it that here. Actual interest on all the borrowing rate. Okay, actual interest that on all the general borrowing divided by weighted average amount of all general borrowing multiplied by 100. On time basis means if you took it between the mid of the year. So obviously for the 6 months we'll take. So let's take one by one. Let's take a question and we'll solve step by step. So go to a super 100 question. First, let's go to question number 46. Interesting question. They say X Limited began the construction of a new building on 1st of January 2016 that. Now it obtained rupees 1 lakh special loan to finance the construction of building on 1st of January 2016. So there is a specific borrowing. A specific borrowing of how much here? Rupees 1 lakh. A specific borrowing how much here? Of rupees how much? The 1 lakh. Then they say that here now at an interest rate of what here? The 10%. So the company's other outstanding two non-specific borrowings. They also have taken a general borrowing. Okay, general borrowing that they have taken. Now, general borrowing. First of all, specific borrowing was at the rate of what? 10%. Okay, I will come to that. But general borrowing is important. That general borrowing. So what happened when it's come to general borrowing? There are two type of general borrowing. We took a loan of rupees 5 lakh and 9 lakh. And what is the rate of interest? 11%, 13%. So for the specific borrowing, no problem. Why? Because we know that is for the specific purpose. We will just multiply by 1 lakh, multiply by 10%, and that will capitalize. But when it's come to the general borrowing, we have to calculate weighted average. Capitalization rate means the weighted average rate. So what is step number one? So they say in step number one that actual interest on all general borrowing. So we took a loan of how much? 5 lakh. So I will write it down here now. Interest, actual interest, 5 lakh multiply by 11%. And here 9 lakh multiply by 13%. How much it is coming at 5 lakh multiply by 11%? That is coming here 55,000. And here 9 lakh multiply by 13%. That is coming how much here? 1 lakh 17,000. Okay, this is the total amount of interest that we have. So 55,000 plus 1 lakh 17,000. How much it is coming? 1 lakh 72,000. This is the total amount of interest. Okay. Now 1 lakh 72,000. This is the total amount of interest that we have. Divided by the total amount of loan. How much is the total amount of loan? 5 plus 9, that is coming 14 lakhs. So divided by 14 lakhs, multiply by 100. Okay. So here 1 lakh 72,000 divided by 14 lakhs multiply by 100, that is coming 12.28%. This is capital weighted average rate. Okay. So we have calculated the weighted average rate in our example. That okay, this is that is given 12 point something. Then they say amount eligible for capital expenses incurred on the asset each date. So on part, I'm going to say that if we're incurring the expense, we'll multiply with the capitalization rate and depend when you incurred only for the remaining bit. Obviously, suppose let's take an example. Here first of all, that when we talk about this, these are the expenses that we have incurred. But when we talk about these 2 lakh, that out of that 2 lakh, 1 lakh basically you incurred out of the specific borrowing. 1 lakh you've incurred out of the specific borrowing. So let me say, okay, 12.285. So that's why I say out of 2 lakh, 1 lakh in the specific. I'm talking the general. Specific is very simple. We'll come to that. So what it says that here, now expense incurred on asset each date multiply by capitalization rate multiply by the expense date to the capitalization end date divided by 12. What does it mean? I will say 2 minus 1 because 1 is a specific borrowing. Multiply by the capitalization rate we incur January. So when we have incurred January, so we'll assume this at the starting of the January. That is for the 12 month. So 12 by 12, 12 by 12. Then we incurred 2 lakh here April month. So April to December 9 months. How much? 2 lakh 50. So 2 lakh 50,000 multiply by the capitalization rate for the multiply by 9 by 12. This much amount is coming now. Now the July that year 4 lakh 50,000. 4 lakh 50,000 July to December, that is the 6 by 12. This is a capitalization rate. This is amount of interest that we're going to capitalize. Now December 1 month 1 lakh 20,000 multiply by capitalization rate 1 by 12. So this much is the capitalization of the borrowing cost. Okay, general borrowing. Now is general borrowing, this much you will capitalize, and for the specific borrowing, which is very simple, 1 lakh, we have taken a 1 lakh loan from the specific 10%. 10. So this much you're going to capitalize that. So what it says, search the general borrowing to be capitalized that here. Low, obviously they say that here, the eligible general borrowing, obviously they are basically saying in point number 3, the amount that you are going to capitalize, it should not be more than the amount that we have incurred. Obviously the amount we have incurred, it should be maximum that much we can capitalize. Okay, so how much the total amount of borrowing that we should be capitalized? General borrowing data, that is 64,189, and on specific borrowing that is was 10,000. This is the total amount we'll capitalize it. So what entry will pass that now? This is the total cost of the building that we've incurred. 2 lakh plus 2 lakh 50, 4 lakh 50 plus 1 lakh 20. So to that here 2 lakh, 2 lakh 50, 4 lakh 50, 1 lakh 20. And this is the amount of what here? Capitalization of borrowing cost. So that will add to the cost of the PP. The total amount is, so building account will be debited with the full amount including the borrowing cost to bank account. Simple is that here? Okay. Now done. So okay. Now again that here, before I come to point number 7, that now we can cover the question number, these all 45. So only on the qualifying asset we can capitalize. So what is a very common way, most of the time, many times basically I say ask the question, this similar question like 45. So they say on 1st of April 2021, Amazing Construction Limited obtained a loan of rupees 32 crore to be utilized at under. They have taken a loan of 32 crore that year. Okay, that is the 25 crore they are using it for the construction of ceiling across 2 cities. Is it a qualifying asset? Yes. Okay. Work was held up to for a bit of month during the year due to high water level. I will explain temporary. It is because that is a part of the process. Okay, high water level, so that's okay that year. Okay, then they say purchase of equipment and machinery. This is not a qualifying asset. Working capital is also not a qualifying asset. Purchase of vehicle is also not a qualifying asset. Advance for tools and crane, not a qualifying asset. Purchase of technical know-how, not is something that should take a substantial period of time. Then only we call them qualifying asset. Now your total interest charge. Okay, this is okay. Total interest that they have charged is how much here? 80 lakh rupees. Now, so if you do that, if you see that out of 32 crore, only 25 crore we have incurred for the qualifying asset. The proportionality will say if 80 lakh rupees is on the 32 crore loan, then how much will be on 25? So 80 lakhs divided by 32 multiplied by 25, that is coming here 62 lakh. How much here is 50,000. So basically 62 lakh 50,000 we are incurring that here now is on the qualifying. So it will be capitalized and all other interest will go to P&L account, because other for the purpose which we have used it, that is not a qualifying asset. Therefore, the relevant expense on those assets will go to P&L account. Only on the qualifying asset, the portion of the interest that we have incurred for the purpose of qualifying asset, that only we are going to capitalize. Okay. So you can see that now 62 lakh 50,000 will be capitalized and the remaining will go to profit and loss account. Simple it is. Okay. Now Done with question number 45. Very common question. So many times I say ask this question because this is only qualifying asset. All other are not qualifying asset. That's why the relevant interest will go to profit and loss account. They have taken the proportionately here. Okay, 80 lakh is the total, that is 32. How much will be on that particular relevant asset? Okay. Now 46 we have already discussed that now. Now for question number 47 I will discuss with you. 47 and 48. Okay, one by one. Now, the next point is that here the commencement of capitalization. When should we do? When should we start doing the commencement of capitalization? Means when we should start capitalizing. So there are three conditions. If these three conditions are satisfied, then we have to start capitalization. What are those three conditions that now? The capitalization start when the expenditure for qualifying asset is being incurred. Obviously, you have started incurring the expenses on qualifying asset. Then borrowing costs are incurred. Obviously, you have to incur the borrowing. If you're not paying the interest to the bank, how you to capitalize it? Then the third is the development activity for asset preparation has started. Obviously, work should be started. You've taken a loan from the bank and you suppose you've gone for the world tour, okay, and from that money you are not, any activity is not started for that particular asset, you cannot capitalize it. Okay, these three conditions: expenses should be incurred on qualifying asset, borrowing cost should be incurred, and the third, development should be started. But they say here some point, note, activity to prepare for an asset for use include technical administrative work before the construction started. Okay, even some activity means that activity they are saying even that here some technical and administrative work, architect and all that, those work also started designing of the building. So they say yes, activity has been started. However, they say they want it here. However, if the asset is ideal, no development work, borrowing funds are not capitalized. Example that here now, land under development. You purchase the land, okay, and you land under development, but you started a development also, the capitalization can do. But land without a development means you purchase the land, you're not doing any development there, so you cannot capitalize. It should not be happen. Let me tell you why they're saying. First of all, they say, let me explain you the development activity. Activity should be started on the qualifying asset. Okay, first of all, if what it says that what do you mean activity, they say even the administrative work or the technical work has been started, like the architect, civil engineer, okay, designing and the architecting, that is also okay. Okay, but they say it should not be happen you purchase a land and you're not doing anything on that. Okay, otherwise people will purchase the land and they will not do the construction for 10-20 years. They will say yes, work has been started because we purchased the land. They say no. If you purchase the land, it should be development should be started, then you can capitalize. But if you purchase the land, if you're not doing a development, then you cannot capitalize the amount. In that case, it will be charged to profit and loss account. Okay, whenever you cannot capitalize, the interest will automatically go to profit and loss account. Then this is cease. Cease means when should we stop the capitalization? Okay, when should we stop the capitalization? So it says that here now, stop capitalization when substantially all activity for the qualifying asset intended for use or sale are complete. It means the almost every work is substantial, means almost 100%. Okay, so almost 100% work has been completed. Okay, almost I'm saying. Otherwise, if they say all activities, so people may argue, no, we have not put that bulb is not working. Okay, like on the entrance of the building, like that. So they say no. Substantially means almost, not necessarily 100%, but almost work has been completed. So then you have to stop charging what? Capitalization. You stop capitalization of the interest. So what should we do? With the loan we have not yet repaid, then interest will go to penal account. Okay. So they say here, what is asset completion? The asset is ready when physical construction or production is done, even if routine administrative work is pending. So that's why they use the word substantial. Not 100%, but almost 100%. So example, minor modification like property decoration indicates substantial what? The completion here. Okay. Then they say here, once the work substantially has been completed, then we cannot capitalize. After that, we cannot capitalize the interest amount. Then after that, still if the loan is outstanding, you are paying the interest, that interest will go to profit and loss account. Then they say for asset built in parts, a cease capitalization for an asset. For asset, when activities for its use or sale substantially complete. Example, a business park with individual usable building during ongoing construction. Let me make it simple for you. Suppose if I say that now here, okay. Now what is going to happen? Suppose this is a building that here. Okay. Now here we are a business park that here. The 4 building we are doing the construction, we took a loan from that. If these has been completed, 2 building has been completed. So we will seize them. If it is, I mean to say if it is completed, then seize means stop. We will not charge, we will not capitalize the interest on these 2 buildings because that is completed. You got the point? Even though remaining 2 buildings is under, I mean to say under work in progress is going on, it's still under construction that year. So for that, no problem, the interest which belongs to these 2 buildings capitalize it because work substantially not yet completed for these two buildings. But for the first two, if the construction has been completed substantially, stop it. So it might be happen. For example, you are doing the construction of a 10th floor building. 8 has been done. The construction for the 8th floor has been done, and you can use those independently, those 8th floor. You have to stop capitalizing interest on that 8th floor. Remaining to is it is still the construction is going on. Then for that interest you are still paying because you took a loan that year. Loan is still not completely repaid. So you have to bifurcate how much belongs to those 8th floor. If construction has been completed, we can use it independently. So we cannot capitalize the interest. Now onwards, interest will go to P&L. And for the remaining 2 floor, the work is still under the construction that year now. So those for the 2 floor, interest that we are paying, that is going to be still capitalized because the substantial all work has not been completed for specific those 2 floors. You got the point here now? Okay. So there is a very interesting question is given in the Super 100 question that I will come to that here now. Now I will come to the part of suspension later on. Now come here. Question number 47. They say Harish Construction company is constructing a huge building project consisting of 4 phases that year. It is expected that the full building will be constructed over several years, but phase 1 and phase 2 of the building will be started soon as they are completed. So they think these buildings have 4 phases. 4 phases they are doing, but phase 1 and phase 2 will be started immediately. And they say it will be completed soon. Okay. Following is the detail of the work done on different phases of the building during the current year, rupees in lakhs that year. So phase 1, phase 2, phase 3 and phase 4. So they say the expenses that we incur, the cash expenditure here, rupees in lakhs. Okay, 10 lakhs, 30 lakhs, 25 lakhs, 30 lakhs. Then they purchase the building that 24, 34, 30 and 30. The total expenditure that we have done, 10 plus 24, 34, 30 plus 34, 64, 25 plus 30, 55, 30 plus 30, that is coming 60. These are the total incurred expenses that they have incurred on these 4 phases. The not total expense. If you do the total of these 4, that is coming here 221. Okay, if you do the total 34 plus 64 plus 55 plus 68, that is coming how much? That is coming 221. But actually they have taken how much loan that they have taken? They have taken a loan at the beginning of the year. How much? 200. Okay, 200 lakhs that they have taken. Okay, but this is during the mid of the current year. Phase 1 and phase 2 have become operational. Find out the total amount to be capitalized and expense. Now understand. If I talk about the phase 1 and phase 2, okay, they completed in the mid of the year. So what we'll do that here now? Mid of the year. So 6 month. This 6 month will be capitalized. The 6 month remaining will be a expense. Expense means profit and loss account. Okay. For phase 3 and phase 4. For phase 3 and phase 4. Okay, what is going to happen here now? This amount, interest on this will be capitalized. The reason is that which is phase 3 and 4 not yet completed. Okay, so we have to bifurcate the amount. So understand it. What is the total interest expense? That is 200 lakhs means 2 crore. So 2 crore rate of interest is given 15%. This is the total amount of interest here. Okay. Now phase 1, how much we incurred in phase 1 and phase 2? 34 and 64. So 34 and 64, that is coming 98. And here phase 3 and phase 4, that is coming here 55 and 68. 55 and 68. So this is the amount that we incurred on phase 2 and 3. This is the total amount on all the 4 phases. Now simply just we are bifurcating here. Total amount of loan is how much? 2 crore. So I will say that here now, total amount of interest is how much? 30 lakhs. I just have to bifurcate these 30 lakhs between these 30 lakhs in the ratio of that here. 30 lakhs in the ratio of 98 and 123. This 98 and 123. So what they do? 30 lakhs. Just give me a minute. 98 plus 123, 221. So 30 lakhs divided by 221 multiplied by 98. That is coming. Just give me 30 lakhs divided by 221 multiplied by 98. Yes, that is okay. One more thing in your notes, they have mentioned 3,30,330. Basically, it is 13 lakhs. So add 1 here. Okay. So here on phase 1 and phase 2, if you bifurcate this 30 lakh in the ratio of 98 is to 123. So 98 for the phase 1 and phase 2. 123 is for the phase 3 and phase 4. They have bifurcated that here now, this amount. I can say that here now. 30 lakhs. If it is on 221, how much is on 98? 30 lakhs. If it is on 221, how much is 123? Okay, done. Very simple. Now we are finding the amount, how much will be for phase 1 and 2 and phase 3 and 4. For phase 3 and 4, I am not worried. Obviously, it will be completely capitalized because which is still under the construction. But phase 1 and 2, which is completed in the mid of the year. So mid means 6 months that. So what we'll do that here, this amount which belongs to the phase 1 and 2, 50% will be capitalized, 50% will be charged to P&L account because it is completed in the mid of the year. So 50% before that capitalized, 50% after that will be P&L account. So 1,30,000. Okay, you can write it down here. 1,30,000. No, not 1 lakh. 13,30,000. Just 1 minute. 13,30,000. 317. Okay, 13,30,317 divided by 2. 50% is coming 6,65,560. 6,65,500 and just 1 minute, not 6,65,000. No, something incorrect here. Okay, just give me a minute. 6,65,150. 8.5, 6,65,158.5. You got the point here now? Okay. Now this 50% that because it's mid of the year. So what happened is it will be capitalized. This will go to P&L. This complete amount 16 lakh here. 69,683 will be capitalized. Done. This is what they have mentioned all this point. Okay. 16 lakh is capitalized 50% that year. Okay. It's done. Now come to again repeat this. Now we are coming to point number 9. Suspension means that here now. Suppose you started capitalizing here. Okay, you start here. Capitalization of borrowing cost. You cease here. Cease here means stop that. But during certain period you have done a suspension here. Suspension means that you stop that here. Suspension means you cannot capitalize. Suspension you stop here. Okay, what is this suspension of capitalization means? You are not capitalizing the interest. But when? Okay, but when? Now we'll discuss that. They say now capitalization of borrowing cost is suspended when the active development is what? Interrupted. Work has been stopped during that particular period. Borrowing cost during such idle period are treated as expense. It means it will be charged to profit and loss account. It will not be added to the cost of the PP. However, they say capitalization continue. We can still capitalize when? If the technical or administrative work is still in what? Progress. If my administrative work still is going on, even the work is not, work is stopped, but administrative work is going on, no problem. Still you can capitalize that during this period also. Then this is the delay is temporary and which is a necessary part of it. For example, inventory maturing period. For example, wine manufacturing, the aging period while the wine manufacture in barrels. It happened that year. So that year we are doing the manufacturing, but we are not doing any work because there is a part of the process that should be kept the wine in the barrel that year. So we can capitalize that year. That is a part of the process. Or seasonal delays like the high water level that during the bridge construction. So during the bridge construction, the now seasonal delay because of high water level. So we know it in advance that this is going to happen and there is a part of the process only. So in that case, even the work has been not done here, even though interest that you have paid to the bank, still that can be capitalized. That okay. Now I'm coming to the last part here now. That is the exchange differences on foreign currency borrowing. You say no sir, this is a part of accounting standard 10. Okay, you will say no sir, this is a part of what? Accounting standard 10. Now understand this point here. What happened that here now? First of all, that here now, yes, exchange difference is a part of not 12, sorry, exchange difference is part of accounting standard 11, not 10, sorry. So here account, this is a part of accounting standard 11, okay, but understand this point here. So what they are saying, understand this step. Now let me tell you the logic behind this, and it will be easy for you to understand this one. So what is the logic behind this? Listen it carefully. So what it says that here. Suppose if I say that now, you have an option that okay, you have taken a loan that here. Okay, now listen carefully. You have taken the loan that here you needed loan of $10,000 that here. So you have two options that here now. What are the two options you have? You took a loan from foreign bank and you have to pay the 7% interest only. If you take a loan from foreign bank here. Okay. Now second option that you have, you can take a loan from Indian bank and pay 12% interest, suppose that. So which option should you choose? You want to take a loan of $10,000. You have the option to take a loan from the foreign bank or you take a loan from the Indian bank, that is 12%. So I will say I will go for the foreign bank because the rate of interest is less there. Okay, but there are advantages and disadvantages both. Advantage is that the rate of interest is what? Low, correct? But disadvantage is that here the exchange rate fluctuation, because I have to repay the loan in what? Foreign exchange. So exchange rate fluctuate, I may bear a loss that here. Okay, so that is the disadvantage. So what it says that here, through an example, it will be easy for you to understand. So let's take an example. I will come to all these steps that here, these 5 steps. They say here, Shan Builders Limited borrow a fund of 10 lakh US dollar at a rate of 4% rate for this project. The exchange rate was for 56 per US dollar at the time of availment, and 62 on 31st March 2026. So at the time of your take a loan, that $1 was equal to 56 rupees. Okay. Suppose, okay, I know that this is not exchange rate nowadays. Okay, 56. Now on at the end of the year, $1 is equal to 62 that here. Okay, now understand. This year, now soon it will touch 100. Okay, now here, the interest is payable at the end of the financial year. If borrowed in INR, the rate would be have been 10.5%. So if we took a loan from the foreign bank, how much of is the amount of interest? That is a 4%. We took a loan from the foreign bank here. Sorry, foreign bank 4%. If you take from India, then it's 10.5%. You are required to calculate the borrowing cost and exchange difference for the year ending 31st March 2026 as per the applicable accounting standard. Step by step. How much loan? How much of amount of interest actually we are paying? Okay. So the first step they say. Let me read it step here and then I will explain it. They say calculate the actual interest we are paying. Okay, if I calculate the actual interest that I am paying here, okay, now understand the point. Just 1 minute. Okay, step number 1. How much loan we have taken? We have taken a loan of 10 lakhs. Let me write it down here. 10 lakhs. Okay, 10 lakhs dollar. Sorry. So we have taken a loan of 10 lakhs dollar. Okay, now what is the exchange rate that we have? What is the rate of interest? First of all, 4%. What is the exchange rate? You will see, no, the exchange rate at the starting of this is 56. Now I'm talking about the how much interest we are liable to. So you will say multiply in rupees. I want to calculate. You will multiply by 56. No, 62. You know why? Because we are going to pay the interest at the end of the year. And what is the exchange rate at the end of the 62? So don't do the mistake here. We are going to multiply by 62 only, because whenever we will pay the interest, the exchange rate will be 62. So 10 lakh must multiply by 4%, multiply by 62. That is coming how much here? Rupees 24.8 lakh. This is the actual interest that we have paid. Okay. Now step number 2 they say here. Step number 2 they say that here now is the calculate notional interest. That if suppose hypothetically if we borrow from the Indian bank, how much interest that would we pay? So that is a 10 lakhs dollar. Rate of interest in India is 10.5%. But here that is a main point. Here I will not multiply by 62. I will multiply by 56. Why? Why? Because in India, if we have taken a loan from the Indian bank, we don't care about the exchange rate. Now, whatever is the exchange rate is starting that year, I mean this much of fund that we borrow. So at the starting of the year, it was a 56. We took a loan of the this 10 lakh dollar that year. So when I will pay the interest to the Indian bank, it will be in rupees only. So I don't care about the exchange rate. So therefore, no need to take that at the end of the year exchange rate. So if we took a loan from the Indian bank, hypothetically, how much interest I have to pay? Calculate there, multiply by 56. That is coming here now how much? 58.8 lakhs. So I've saved certain interest by taking a loan from the foreign bank. The third step is that here, calculate the saving interest step 2 minus 3. So this interest I have to pay in India. If I took a loan from Indian bank, 58.8 lakhs. We took a loan from the foreign bank, that is 24.8. So how much it is coming that here now? 58.8 minus 24.8. That is coming how much? 34 lakhs. 34 lakh is the amount of saving that we have. Okay. 34 lakh is the amount of what? The saving we have by taking a loan from the foreign bank. Okay. Now what happened? Because if we took a loan from the Indian bank, that much we have to pay. We took a loan from the foreign bank, that much actually we are paying. So we save this much of interest that you know. Then if I come to step number 4, they say calculate the exchange difference on foreign currency. So foreign currency that is, so foreign currency, how much the loss we have here. This is the advantage. This is the advantages we have. This is the advantages we have. We save that much of interest that year. Now what about the disadvantage, the exchange loss? Okay. So how much loan we took? We took a loan of 10 lakhs. But exchange rate at the end of the year, how much is the exchange rate at the end of the year? 62. How much is the exchange rate at the starting of the year? It was 56. So the loan which was the exchange value increased by how much? 6. So 10 multiplied by 6, that is coming 60. So I am at a loss of 60 what? So this is a disadvantage to me. Why? Because the loan, this is disadvantages to me. Okay, disadvantages to me. Why disadvantages to me? Because this much, the loan that should be 10 multiplied by 56. If I say 10 multiplied by 56, 560 lakhs. Okay, but now it is 620 lakhs. The reason is that here because of the increase in the exchange rate that here. Okay, these are disadvantages I have. You got the point now? So you will say if it is a disadvantage, should it take it to P&L account? No. These what accounting standards say no. Don't take it to P&L. Some will be capitalized and some will take to P&L account. Okay. So how much we can capitalize? Maximum this much we can capitalize. So 34 lakhs will be capitalized. And the remaining 60 is the total loss, 34 will be capitalized and 26 will be charged to P&L account. This is what the treatment is at here. Okay. So it will be charged to P. You can see that now is the total exchange loss is 60 lakh. 60 lakh exchange loss step in the 34 lakh the saving in interest treated as a borrowing cost. Okay, 34 it will be capitalized. It will be treated as what? A borrowing cost that here now. Remaining that here, if any, recognized in what? As per AS 11, 60 lakhs minus 34, that is coming 26, it will be charged to P&L account. Okay. Now they say here, now next step. Okay. Now the fifth step is that a total, basically they are saying how much a total is the borrowing cost. So this is the borrowing cost that we have capitalized here. This is the borrowing cost that we have capitalized here. And this is the actual that we know. Where is the actual one? The first one. The total borrowing cost, actually I have paid 24.80 plus the exchange loss that we can capitalize, that is coming 34. So this 24.8 plus 34, that is coming 58.8. It will be capitalized total. Okay. So the same question, the figures are different, but in the top 100 question number 48 is homework. Same question, just follow these 5 steps, you will get the answer there. Okay. You will get the answer there. So 48 is homework, then 40 from the 49 is 17 starting. Okay, so this is all about accounting standard 11. Accounting standard 16 is that. Okay, then next session I will start accounting standard 17, that is segment reporting. That is for today. Take care all of you. And if you like it, please comment and tell me what are your feedbacks that. Okay, thank you so much. Take care all of you. Bye bye.